Welcome to the sixth webinar in our series for Women in Focus. My name is Margaret Munetsi, a principal with CountPlus One. We, in the series of Women in Focus, are focused on the influences that women have in this world of finances. We're focused on tax planning and structures within the tax environment. We're focused on wealth management and the things that life throws and different aspects and journey within this journey of financial management. We've, with the wealth management team, explored different aspects and things that life throws within that journey. We have today Scott Relf joining us from our wealth management team, and he's going to be focusing on goal-based investing and how to structure a portfolio to help with this and structuring this portfolio using this tool. Scott, welcome, and over to you.
Thank you, Margaret, and good afternoon, everyone. My name is Scott, and I'm very happy to be discussing goals-based investing with you today. As Margaret mentioned, I have an investment background, and this is an area where I get great enjoyment and rewards from when working through the portfolio construction process with clients. The desired outcomes of today's presentation include outlining how goals-based investing is an approach which aims to help people meet their personal and lifestyle goals, some research behind behavioural economics and how goals-based investing aims to mitigate the risk of making irrational decisions. I'll discuss how COVID-19 and low interest rates have and are impacting financial markets and expectations for the next 12 months. Presentation will go for approximately 25 minutes, and there'll be an opportunity for a Q&A session of around 5 minutes towards the end. Please feel free to ask questions by clicking the Q&A box at the bottom of your Zoom window. All questions will be responded to either in this session or via a follow-up email. In terms of resources, there's a rate of return calculator which will be emailed to all participants following this presentation. Before we discuss goals-based investing, I would like to initially provide an overview of the traditional investment approach to help understand the main differences. Below, I have outlined some examples of how portfolios have traditionally been constructed. The use of wealth maximization at retirement as the default goal, being solely focused on an individual's risk profile in comparison to defining what you would actually like to achieve before determining an appropriate level of risk. A one-size-fits-all approach, which can include pre-packaged investment solutions that best match an individual's risk profile without initially defining your goals. The traditional approach, therefore, often doesn't take into consideration that every individual is unique with different goals and priorities that can occur well before retirement. Before I outline how goals-based investing differs from the traditional investment approach, the most important initial step, the portfolio construction and advice process, includes defining an individual's SMART goals as previously outlined in the prior Women in Focus presentations. Defining an individual's SMART goals includes articulating and defining goals and setting a timeline, quantifying and measuring the cost of those goals, assessing the reality of achieving those goals or determining what revisions may need to be made, prioritizing those goals, which links back to determining appropriate timeframes. SMART goals, therefore, stands for specific, measurable, achievable, realistic, and time-bound. Now, how does goals-based investing differ? Goals-based investing includes developing a deep understanding of an individual's current situation and setting smart financial and lifestyle goals. This is the first step before the portfolio construction process begins in regard to achieving those goals. Investment risk isn't measured by outperformance or underperformance versus a specific benchmark. It's about, will you be able to achieve your goals, or what do you need to consider and change to ensure that you remain on track to achieve those goals? Investment solutions are designed based on forecasting the required rate of return needed, which leads on to ensuring that your goals are prioritised and appropriate timeframes have been identified in order to assess the reality and effectively manage investment risk. To help illustrate goals-based investing in practice, I will take you through two examples with fictional characters after discussing this slide. Goals-based investing begins by answering the most important questions first, essentially the what, the why, and the how. What are your objectives? Why are you investing? What are your timeframes, which will determine how we should construct a portfolio? Defining your goals allows you to calculate the required rate of return needed to get from where you are to where you want to be. This is how goals-based investing really differs, as knowing your required rate of return and investment timeframes will provide answers to two fundamental questions. Firstly, is your portfolio allocated to the right asset classes to achieve your goals? Now, secondly, how are you tracking against your goals, and do you need to consider making adjustments? Regarding the question, why are you investing? It's important to understand the difference between saving and investing. Saving is a way to protect your money for a short time frame. It is low risk. You earn interest on your savings at whatever rate the bank sets, and it is taxed at your marginal tax rate like any other income. On the other hand, investing is a strategy to grow your wealth over the long term. It carries greater risk because it's tied to market movements, which can go through periods of volatility. However, you can also have the potential to earn income that is higher than interest rates on savings accounts. So while saving can make it possible to achieve your short or even medium-term goals, you might consider creating or retaining an investment portfolio to help you reach your long-term goals. To show how this works in practice, I've provided an example with a fictional character called Sarah, who is currently early in her career with no financial dependence. Sarah would like to purchase a property as a first-time home buyer for $500,000 in today's dollars, with ideally a 20% deposit and within 8 years. Sarah has $10,000 to invest, a base salary of $60,000 per annum, and living expenses of approximately $40,000 per annum, including some travel. Taking into consideration inflation, we have determined an estimated purchase price of $595,000 at the time. A 20% deposit will equal $119,000. If $10,000 is invested, plus estimated savings post-tax of $9,000 per annum, and investment income is reinvested, we have determined that Sarah would need a rate of return of approximately 6.37% per annum to achieve this. And based on this rate of return, Sarah will need a growth investment strategy to achieve this rate of return and goal. The pie chart you can see illustrates that for a growth investment strategy, Sarah would need approximately 80% invested into growth assets and 20% invested into defensive assets, which I'll explain further over the next few slides. After determining the rate of return and growth investment strategy that Sarah requires to achieve her goals, it's important to understand Sarah's attitudes towards investment risk. As every individual investor responds differently to volatility, understanding the different risk profiles will help you before constructing the most suitable investment portfolio. For example, a defensive investor is focused on protecting their investment capital and having total peace of mind. A moderate investor will create a portfolio that takes on some short-term risk for potential long-term growth. A growth investor has a higher threshold for short-term risk in order to achieve greater long-term capital growth. There are four main asset classes, which we divide into two categories: defensive and growth. Defensive assets have lower risk as well as lower potential returns. These include cash, such as savings accounts in the bank or term deposits, fixed interest, including bonds, which provide regular payments for an agreed period of time. Some fixed interest investments, like bonds, also have the potential for capital growth depending on market movements. Growth assets carry higher risk, but also have the potential for higher returns. These include shares, Australian and international, property, which also includes property securities or shares in companies that manage properties. Growth assets tend to be longer-term investments as they need to ride out periods of market volatility and increase in value over time. I have included a risk and return chart to see where these assets lie. We can see that cash and fixed interests are on the lower end of the risk and return scale. A defensive portfolio will be made up of these types of assets to reduce risk as much as possible. Property and shares are on the higher end of the risk-return scale, and a growth portfolio will include mostly these types of assets to generate greater capital growth long-term. The next example also includes a fictional character called Olivia, who is established in her career and a homeowner with 2 children. Olivia would like to continue paying down her home loan of $400,000, fund school fees of $7,500 per annum each for 2 children through secondary school, retire in 20 years' time at the age of 65, debt-free and with an after-tax income of $50,000 per annum to cover living expenses and some travel. Olivia has a base salary of $115,000 per annum, a home loan of $400,000 at 3% principal and interest, living expenses of approximately $50,000 per annum, a total super balance of $80,000. Olivia is making salary sacrifice contributions of $500 per month to super, and she has life insurance premiums of approximately $1,500 per annum. After modelling Olivia's current situation and goals, we determined that Olivia needs a rate of return of approximately 5.9% per annum to meet her goals. Based on this rate of return, Olivia needs a balanced investment strategy to achieve this rate of return and goals. The pie chart illustrates that for a balanced investment strategy, Olivia would need approximately 70% invested into growth assets and 30% into defensive assets. When referring back to the risk and return chart, a balanced portfolio will be somewhere in the middle of moderate and growth, as it combines some defensive and some growth assets in order to achieve the rate of return required. After determining and agreeing on your required rate of return and risk profile, the next step involves understanding your investment preferences by breaking down investment options within each asset class. For example, direct shares listed on the Australian Stock Exchange, managed funds, exchange-traded funds, term deposits. For example, we have recent new clients who have inherited direct share portfolios. However, they may not have the risk appetite or need based on their situation and goals and objectives. As a result, they would like to consider diversifying their existing investments to reduce the additional fluctuations that take place by owning direct shares in comparison to a managed fund or exchange-traded fund. Understanding how comfortable you are with the options available, taking into consideration any prior investment experience, will help determine the most appropriate portfolio for you moving forward. The portfolio construction process also includes discussing various investment themes that need to be taken into consideration. Some examples include the following: the recent market volatility and concentration risks associated with the different investment options available, investing in large blue chip companies versus mid to small size companies, developed versus emerging economies, listed versus unlisted investments, and the additional risks associated. For example, did the fluctuations that your investments experienced last year as a result of COVID-19 cause you to consider panic selling, or were you happy with the diversification in your portfolio that helped provide a defensive buffer? If you are with an industry super fund, are you comfortable with the potential exposure to unlisted property assets and the additional liquidity risks associated? Bringing it all together, now that you've achieved the following: set clearly defined goals, set investment timeframes, determined your required rate of return, determined your investment preferences and understood relevant investment themes, it's time to move forward with constructing your portfolio and the strategic asset allocation. Moving on to behavioural economics. This studies the effects of psychological, cognitive, emotional, cultural and social factors on the decisions of individual investors. According to external Morningstar research, the primary investing-related consequence is not having any sense of the actual return objectives needed to meet your goals. This can lead to individual investors going into two default modes: either risk avoidance, where too many assets are kept in safe assets such as cash or term deposits, or wealth maximization, where too much risk is taken relative to the actual investment objectives and timelines. Goals-based investing and having a long-term strategic investment plan sets out to avoid irrational decision-making, which we believe can only be a benefit in the current environment. For example, with appropriate risk management, investment timeframes, and diversification in your portfolio, you should avoid being in a position where you need to sell down on your growth assets to fund certain outgoings, such as pension obligations or funding for a property deposit during periods of greater market volatility, as we have experienced as a result of COVID-19. Sticking to your long-term investment plan will allow you to benefit from an economic recovery, such as the recovery that is continuing here in Australia and overseas. Before I discuss the economic outlook, I've included this chart to help put the COVID-19 Australian recession and rebound into perspective. The vertical axis illustrates when each economic cycle peaked, representing 100, whilst the horizontal axis illustrates the time taken in quarters for each economic cycle to go from peak to trough and recovery. This therefore compares the economic contraction experienced in 2020, being the first recession in Australia in nearly 30 years, to the recessions and recoveries of the mid-70s, early 1980s, and early 1990s. As you can see, the COVID-19 recession was roughly twice as severe as the 1980s recession, and roughly 3 to 4 times more severe than the 1970s and 1990s recessions. If anyone is surprised that the global financial crisis in 2008 isn't there, it's because Australia was the only major economy to avoid a recession at the time due to demand from China and the resource boom. However, the rebound from the COVID-19 recession has also been a swift and V-shaped recovery as lockdowns and restrictions have eased and the virus has been contained. The rebound is also expected to continue, taking into consideration that government support measures such as JobKeeper and the JobSeeker supplement are expected to be pulled back soon, as additional stimulus provided by the Reserve Bank of Australia remains strong and the vaccination rollout has begun. In terms of the global economic recovery, this slide includes forecasts provided by the International Monetary Fund, an organisation including 190 countries whose primary purpose is to ensure the stability of the international monetary system. The International Monetary Fund predicts a global recovery to continue this year from the deep recession caused by COVID-19. The Eurozone economy is expected to lead the way, followed closely by the US, the world's biggest economy. Japan, the world's third largest economy, is also seen bouncing back. The world's second largest economy, China, which is still classified as an emerging economy, is expected to enjoy economic growth just shy of 8% in 2021. In respect to interest rate expectations, the Reserve Bank of Australia has made it clear that they do not expect any changes to the current base interest rate of 0.1% until 2024 at the earliest. Plenty can potentially change between now and then. However, low interest rates can be a challenge for investors who, for example, like the certainty of holding larger amounts of cash or are in pension phase and therefore rely more on defensive assets to fund withdrawals. To help manage the challenge of low interest rates, I would like to finish with a viewpoint from one of the world's largest active global fixed income managers, PIMCO, who have been around for nearly 30 years. According to PIMCO, the global economy and financial markets should transition from intense near-term pain to gradual healing over the next 6 to 12 months. However, there is a risk, if not a likelihood, of an uneven recovery with setbacks along the way. Investors should brace themselves for a very different investment landscape as the weakest areas in the global fixed income market may become exposed. While this should create more attractive opportunities, PIMCO's view is to remain patient and focus on opportunities that they see as high quality assets for now. Overall, the key message from PIMCO importantly focuses on retaining high quality investments, whilst not being tempted to move too high up the risk curve in order to try and generate a high yield, taking into consideration that interest rates are low and expected to remain low for some time. Goals-based investing will help ensure that a portfolio remains constructed in line with the overall rate of return required to meet an individual's goals, ensuring that investors continue to focus on quality with adequate protection in the portfolio against any future distress scenarios that may eventuate. In terms of what's next, please have a go at the rate of return calculator, which will be emailed to you shortly. And feel free to reach out to us via email to schedule a complimentary half-an-hour discovery session. Establishing an investment plan and importantly implementing that plan. And please follow the CountPlus One page on LinkedIn to stay up to date regarding future events and initiatives. I just need to wrap up with a general advice warning, which states that any advice provided in this presentation is general advice only. As in preparing it, we did not take into account your investment objectives, financial situation, or particular needs. Thanks again to everyone for your time today.
Thank you, Scott. That was excellent. I'm sure everyone listening will appreciate the market insights that you've given us, especially in the current challenges that we all face and the unique market environment that we've been operating in. Thank you, Scott. Scott, also thank you for the insights into the goal-based investing and giving us tools I think that will help us explore each of our personal circumstances, such as the rate of return calculator that you'll share with us after this, and that will help us hopefully take you up on the offer to look at constructing a portfolio using, that calculator and using the defensive and growth mechanisms and classes to create that portfolio. Hopefully everyone on the webinar and those that are interested who would like to explore that will take Scott up on that offer. Please remember, we do have a question and answer box at the bottom of your screen. Please pop in any questions that you may have. There are a couple that have come through, Scott, if you don't mind answering those.
Sure.
The first one is, and we get this quite often at the end of each of the webinars, is it too early or too late to start to actually look at goal-based investing at any point in time?
Okay. So I think thoughts on that are it's certainly never too early or too late. And I think initially we can refer back to the example I provided with the fictional character Sarah, who was early in her career, just starting out and wanting to plan for a future property purchase. So I think the earlier clients and investors can really think about what they want to achieve longer term and get into the habits of establishing plans around that will only really help place them in a better position sort of longer term. For clients who are in pension phase, again, never too late, and it could be a good opportunity if the goals-based investing approach hasn't been applied before to review the level of investment risk in their portfolio, and just to make sure that it is appropriate and in line with what you would actually like to achieve in terms of your retirement income objectives. So.
And that's true, Scott. I think you and I have worked on a number of clients where we've used the term restructure, where we've looked at portfolios that have been there for a number of years, and that we've worked together, not only from a tax planning point of view, but from a wealth management point of view, and actually use a goal-based investment technique to ensure that we're actually looking at it holistically and ensuring the client is in the right frame of mind or to set them up for that ultimate goal. Another question that has come up is, how often is a portfolio actually reviewed to ensure that it actually sits within that goal-based investment frame of mind?
Okay, sure. Yeah, generally speaking, it's normally an annual review as a minimum. However, this really depends on the level of complexity to the client's situation and portfolios. So, for example, clients who might have a much higher allocation to direct shares, where there are additional risks attached, we would be reviewing that more regularly. So, for example, I have some clients who I review quarterly to half yearly. So it really depends, but the range, is from quarterly to annual in general.
Okay. Another couple of questions, Scott. When you refer to property in terms of assets being invested in, are you referring to residential properties and rental properties, or is this properties within a larger market, i.e., organizations whose underlying assets are property?
Yeah, so that would more relate to it could relate to both. However, I would say it'd be more relative to commercial property in general. So an example, I did refer to an example of industry super funds in that regard, where they will pull assets together and they will go out directly and purchase commercial property or certain infrastructure assets within that area. So more towards commercial property is the answer in general, but it's important that clients understand the additional liquidity risks of those unlisted assets versus purchasing, let's say, an exchange traded fund or managed fund, which would go out and purchase listed property securities, where there's a lot more liquidity associated.
There's a question just to understand non-traditional investments. What is your take on non-traditional investments such as cryptocurrencies or Bitcoin in terms of growth and risk profiles?
Sure. Well, that's certainly an area which is we're getting more and more inquiries about in general. Within the way we operate, so we operate under a license holder, which is Count Financial. And in terms of the research which supports everything that we recommend, cryptocurrency is not something which we are approved or authorised or include in client portfolios at this stage. Whether that changes or not in the future, we shall see, but it's certainly an area which is attracting a lot more attention.
And not to say that it's not something that we do see on clients' portfolios, where we have seen a bit of that.
Yeah, that's right. Yeah, certainly we do come across it. It's not something which is included in our advice. However, it's something which we take into consideration to make sure we understand the big picture that relates to the clients and their situation. But and just highlighting the additional sort of risks which are associated with those particular investments.
Yeah. Look, I'm conscious of time. There are a few more questions that have popped up. If you have asked questions, we will look to contact you and ensure that we answer those questions. Your name has come up on the board, the question and answer board. Thank you for your time, Scott, and thank you for anyone who's attended this webinar. Over the next few weeks, please notice that we are looking to change the format of our webinars and the way that we interact with you, as everything sort of allows us to change the format of the way we interact with you, hoping to introduce a more families in focus series, which allows us to interact more with you, allows you to be able to tap into resources from our wealth management team as well as from our accounting team, and allow you to ask more questions and be more interactive with us and hopefully have more face-to-face contact. We're hoping to have you within our office premises to see our new offices. So please watch the space and hopefully you can join us. Please take Scott up on this offer on any of the offers we've had over the series and reach out to the team so that we can assist you as you take on your journey with us at CountPlus One. Again, thank you for attending the series. Goodbye and thank you.
Thank you.
Bye.